Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Dave Kranzler, editor and publisher of Mining Stock Journal, and also editor and publisher of Short Sellers Journal. And Dave, it's been a while since we've had you on the KE Report. We were remarking offline, it's been too long, but we picked a good day to do this because I wanted to get your thoughts on the precious metals just to kick things off. And it looks like gold's made at least intraday, a new all-time high today. Silver's doing pretty good. What's your thoughts on the precious metals here?
Shed, thanks for having me on again. I think the market action today kind of speaks for itself. The front month gold contract is 2468, which is a new all-time high by $3. So I think aside from the political volatility and the geopolitical volatility, et cetera, I think what the market's really responding to is, well, I'm not sure how many people who actually pay attention believe that the rate of inflation is what the CPI tells us what it is. I mean, when you look at, like, you just take the last CPI report, for instance, and you can go through it line by line and see where they're fudging things. Well, first of all, they said food prices went down from May and June. I mean, I did not experience that. And when I go to the grocery store, I pretty much buy the same basket of items for the most part. So, I mean, and I did not experience lower food bills in June. And also the price of gasoline at the pump, yeah, it went down in the first half of June. And that's where they get their sample for, is it usually in the first half of the month for energy. And I think for most prices, but gasoline and gasoline futures started rising in the second half of June. So, who knows? I'm sure they're going to rig a number in July because now I guess Powell's talking about, it sounds like the market thinks there's a 100% chance the Fed's going to cut rates in September. And I think that's what gold and silver, well, and the Dow are responding to today. I mean, the Dow's up over 500 points. So, but interestingly, and I've been writing about this in my newsletters, is that the Fed is actually conducting a stealth quantitative easing or stealth money printing. And I don't see a lot of people talking about this because when you see graphs of M2 posted on social media, they look at the year over year percentage change. But M2 has been rising since October 2023. And the monetary base has been rising since March of 2023. So the money supply, as measured by those two measurements, has been increasing. It's been going up. And that's despite the fact that the Fed is still conducting its quote unquote quantitative tightening. And the other interesting aspect of this is that if you look at the reverse repo facility, and I know it was beat to death like a horse on social media for a while, and then people kind of stopped talking about it. They got bored with it because everyone thought it was going to run out. Well, I didn't, but everyone thought it was going to go to zero by the spring this year. But it has been drained of 1.8 trillion in the last year. Now, the Fed could keep that liquidity captive if it wanted to. It just has to hike the rate that it pays on that facility by a little bit. And the money market funds and banks that were putting their money in there would leave their money in there. But the Fed hasn't. It's let that facility drain. And that money eventually finds its way into the real economy. And a big part of that component is the money market funds take that money and invest in new treasury issuance, and then the government turns around and spends it, and boom, it's in the real economy, and that's what's causing real inflation. And I think that financial conditions, and there's a couple different entities that put out their financial conditions index. I was looking at the Chicago Fed financial conditions index for my short sellers journal last week, and financial conditions are at their easiest since right before the Fed started hiking rates. So you got a financial system and even a real economy now that's awash in liquidity. And that's what's causing real price inflation, not as measured by the CPA, but the real price inflation that households experience. And I think that's a big part of what's driving, away from the obvious massive physical demand from the Eastern Hemisphere. I think that's a big part of what's driving the prices in gold and silver right now.
Yeah, there's definitely a lot of cross currents with what the Fed is doing what's happening with interest rates, what's happening with inflation. And gold is a signal to the rest of the world, and it's happening in almost every global currency, hitting all-time highs, that there is a race to the bottom in many fiat currencies as far as their purchasing power, regardless of what the dollar index is or what the currency pairs are. Their actual purchasing power is going down, as evidenced by gold and silver going up. So it's an interesting time for the precious metals, but Dave, a lot of people have written us over the last year or two asking what's the deal with the precious metal stocks. And they have underperformed people's expectations, but they have been responding. I mean, as we talked today, GDX, for example, is up over $39 at a 52-week high. So they are responding. But what's your take on the mining stocks in general, why they've underperformed people's expectations? Because if we took a time machine back a couple of years and told people, hey, 2,400, almost 2,500 gold, I think most people would have expected things to have gone a little higher in the gold and silver stocks.
A lot of people, including me. Well, I mean, there's two ways to look at it. I think there's some complexity there about why the mining stocks are lagging gold and silver badly. They're not quite as undervalued relative to the price of gold as they were in early 2001, which is when I kind of jumped into the sector. But I think a big part of it is, well, there's two big parts. One is I think it's a trust factor. And really since late 2011, every time there's been a nice rally in the precious metals, suddenly they get smashed again, right? And I choose to believe that it's intentional manipulation and price control for official purposes. A lot of people think that's conspiracy theory. There's been more and more information, a lot of it put out by GATA over the years, over the last couple decades. I mean, it's hard to ignore the facts and the footprints in the snow leading to that conclusion that they're manipulated for official purposes. And so whenever we've had a big rally, I mean, let's just take, the run up that we had from the beginning of 2016 into August. Gold and silver, performed really well, and the mining stocks soared. And then boom, after August, we had probably about a 2-year period where they were in a downtrend again. And we saw the same thing in 2020. So I think there's a trust factor there from the precious metals investing community where they're like, okay, I'm not sure I believe this rally, or, I'm not going to be Charlie Brown with Lucy holding the football again, right? And I'm not going to pile into the mining stocks because they're just going to smash the prices of gold and silver again. So I think that's part of it. What I would say to that is, yeah, I mean, I've fallen into the same trap over the years, but this time it definitely feels different. And probably, and I've written about this recently, probably one of the biggest factors there is the physical demand coming from the Eastern Hemisphere. Yeah, in the first decade of the precious metals secular bull market from 2001 to 2011, China has always been in the background accumulating a lot of gold, same with Russia and same with India. But beyond that, there wasn't much central bank buying. And obviously, in the last couple of years, we've had, I guess, 2 years in a row of record central bank accumulation. And people just throw out central banks generically, but it's the Eastern Hemisphere and Middle Eastern central banks that are buying the gold. It's the actual physical gold that has to be, and they're taking delivery of it. It's not the Western central banks. I mean, who really knows what's going on at the Fed with its alleged gold holdings? So I think a big component of why they haven't been able to control the price of gold since it's broken out is that physical demand. And I also think there's a growing scarcity of physical supply that can be delivered into these buyers. So I think the way gold and silver are behaving since it started rallying, and really, if you look at a chart, I mean, gold's been in an uptrend since October of 2022, quietly in an uptrend. But I think that trust factor has been a big part of the investing community's reluctance to follow gold and silver by taking advantage of the upside leverage in the mining stocks and investing in them. And then I think the second factor is, I mean, why would, for the last 6 months, why would you put your money into anything besides Nvidia, right? Or, the Mag 7 or some of the meme stocks. And so I think there's been an obsession with the tech sector from the wider investing community outside of traditional mining stock investors, and they're busy printing profits by investing in and chasing the momentum higher in tech stocks, and they're kind of ignoring the mining stocks. Well, that'll change when the rug gets pulled out from under the Nasdaq, which it will. It's just a matter of time, and I think it will happen this year. And I think what you'll start to see is funds looking for other places besides tech to put their money, and probably the most compelling value sector in the stock market right now are the mining stocks. I mean, you just look at like their valuation relative to their NAVs, and the present value of their cash flows if they're producing, or the net present value of the junior development stocks that if they have viable projects, and they're just extraordinarily undervalued. I mean, it's insane. And I think that'll change. And I think we're transitioning into that change now.
Yeah, I think some solid points there, Dave, as far as different reasons why maybe the trust factor is not there for investors, but also everybody piling into the tech stocks and just the valuations that we see in the mining sector now offer compelling risk reward setups for people that maybe new generalists to do come over and take a look at the sector when we start seeing Q2 earnings come in and we start seeing some of these mining companies really making good money. You brought up a great point, though, in another interview I was listening to you on about some investors kind of punishing certain stocks based on the jurisdiction risk that they perceive. And there's a difference in the valuations they're receiving, maybe already pricing that in, and then the reality of that these jurisdictions maybe aren't as risky as people think. And meanwhile, some of the quote unquote safer jurisdictions like the US and Canada aren't necessarily risk free either. So I'd love you to maybe talk about when you're in your own portfolio, some of the companies you hold, how you look at jurisdiction risk, and are you willing to take a chance on some companies that are not in considered tier one jurisdictions?
I mean, I don't necessarily believe in differentiation between tier one and tier two, and don't even bother jurisdictions. I'll look at anything, and if it's cheap enough, even if I think there's a lot of jurisdictional risk, I'll put some money into it. Well, first of all, you kind of touched on it. The U.S. isn't necessarily as jurisdictionally risk-free as it's perceived. And in many states, it's difficult and takes a long time or is impossible to get a mine permitted. And Canada is that may be the safest jurisdiction, but there's still risks there. You're not guaranteed of getting a permit. In British Columbia, it can take forever to get permitted. And there's risks that people don't consider when they're looking at juniors, especially, which is logistics risk, location to power, location to avenues of transportation to get what you're producing to ports, et cetera. Where I really started looking at jurisdictional risk with an open mind is when Fortuna bought Roxgold in West Africa, because people think of Africa and like, oh no, I'm not putting my money there. It's too risky as a jurisdiction. Well, some countries that's true, and some countries it's not true. I flew over there to the Cote d'Ivoire for their first gold pour at their Séguéla mine, and I would say the Cote d'Ivoire is probably that actually may be the least risky jurisdiction of any in terms of mining assets, but people still perceive it as risky. So, and then when Caliber Mining took a big hit, and a lot of people had asked me to look at it, I'm like, no, it's in Nicaragua. And it took a big hit because the Biden administration put sanctions. It was actually the president of Nicaragua and any kind of business that he benefited from put sanctions on the U.S., purchasing those products or whatever. And Caliber Mining took a hit because it's got its primary asset in Nicaragua. Well, I took a look at it and I did some studying on Nicaragua as a mining jurisdiction. And it's, to be honest, I would say it's probably much easier to get a mining permit in Nicaragua than it is in the United States. And I put that in my mining stock journal, I don't know, maybe about 18 months ago, or maybe even less than that, a year ago, when it was at 80 cents. And I haven't looked at it today, but it's been as high as, in the $1.60 since then. I think it's pushing $1.60 now. So, I I think people have a gut reaction when they hear about countries that they maybe in the 70s were banana republics, or maybe they still are, and they're like, oh no, it's too risky. The government's going to seize the mines. Well, if the Nicaraguan government seized the mines in Nicaragua, who the heck would operate them? And they're enjoying a huge amount of tax revenue from the mines, so they're going to leave them alone. We talked about Silvercorp before we jumped on the podcast, and they're in China. And I'm pretty convinced that part of the reason, and that's overvalued by 50% at least. And I've chatted with management and I've done, a deep dive on the company. And that management team is really smart and they know what they're doing. They know how to develop mines, and they know how to operate mines. And China's probably the gold friendliest country in the world outside of India, right? I mean, we know the Chinese put all their disposable income in gold and silver mainly in the form of jewelry. The Chinese central bank is accumulating a massive amount of gold. And if the Biden or whoever the next government is were to slap big tariffs on Chinese products that are imported into this country, who cares? Silvercorp sells every ounce of silver that they produce to Chinese customers, and most of them are within a pretty close proximity to where their mine is. So I think right now, if you're willing to be open-minded about where a mining company is operating and look closely at the jurisdictional risk, I think that's where, for as good a value as the entire sector is now, I think that's where there's incredible values right now.
Yeah, Dave, I think it's such a solid point because sometimes that's also where the big deposits are that haven't also been worked over for several decades. And it's also,
Exactly.
in many cases, they're receiving a huge discount for being in these perceived risky jurisdictions. But when you look at the operational track record of a companies like you mentioned, like Silvercorp or like Caliber, they've been blown it away in those areas, or Fortuna's been doing just fine in West Africa. So I think sometimes the risks are overblown and the perceived non-risk and quote unquote safe jurisdictions are maybe too complacent. So it's definitely an area to look for opportunities in the mining sector. There's a lot of opportunities in the mining sector in general. And it was great to have you on the show today just to talk about the precious metals, the mining stocks, and how you're seeing things, Dave. And if people want to follow along with your work, maybe just give them a 1 minute snapshot of what you do for subscribers at Mining Stock Journal and at the Short Sellers Journal.
Sure. Well, you can get more. There's links at my blog, investmentresearchdynamics.com. You just put up a blog about the housing market. The Mining Stock Journal is every other week, and I put it out on Thursday after the market closes. And I have what I call kind of a portfolio of companies that I recommend and that I follow. And with almost all of them, I've spent time on the phone with management. Some of the managements I'm friends with, and I invest in most of those companies, and I disclose when I invest and what kind of weighting I have in my account when I invest in them. And then I also feature new ideas. I just put a new idea that's in a perceived risky jurisdiction in my last issue that went out last Thursday. And then the Short Sellers Journal is kind of it is what the title says, and that's a weekly. And I review the market, I review the economic data, and then I discuss ideas for shorting stocks. So, and I think most people on social media, or at least Twitter, know that I'm a big Tesla bear, and I'm actually an NVIDIA bear. It's just a question of when you want to devote your capital to shorting it.
All right. Well, definitely two resources that we'll put links to down below so investors can follow along with either of those reports. Dave, I appreciate you coming on the KE Report again, sharing how you're looking at things, and looking forward to our next conversation.
Thanks for having me on again, Shad.